This analysis report we're looking at focuses on Clean Energy Technologies, Inc., ticker CETY. It's trading at about 96 cents, and the whole piece is assessing its potential as a high volatility, a meme stock.
Right. We've got the material, and we're going to bypass the general stuff and just dive straight in. We'll look for some high-level opportunities to make this report more robust, more focused for the expert traders it's trying to reach.
So a key theme, really the core of it, seems to be the mathematical probability of a pretty significant volatility event. The analysis does a good job identifying CETY as a potential powder keg.
A powder keg, yeah.
It's got that combination of an extremely high short interest, estimated around 40% of the float, and a really small micro float. We're talking only about 3.0 to 3.2 million shares.
And those are the metrics that get people's attention.
Exactly.
But it's not just the squeeze metrics. The report also highlights some important recent, positive catalysts.
Like the BES deal.
Right, the $10 million battery energy storage system deal, and also the launch of their new HTAP platform. It kind of positions the company right in the middle of these really hot sectors: AI data center energy and green infrastructure.
So it gives a fundamental story to back up the speculative trade, a reason to believe.
Yes. And as I understand it from the notes, the whole argument is compelling because while that bullish setup is powerful,
Right.
the ultimate downside risk is really anchored by two very critical non-technical factors.
Okay. First, the number one danger, financing risk because of a high cash burn rate. And second, just the absolute importance of holding that key technical support level at 90 cents.
That framework opportunity versus that foundational risk, that's the right way to look at a trade like this. I mean, the metrics for the volatility case are laid out very clearly. It's a fascinating setup. But if we're really targeting that sophisticated speculative trader, we need to integrate the risk and the actionability from the very first sentence.
Okay, so let's start there. The analysis report needs to better manage the tension between its high-energy, contrarian meme stock angle and the really serious fundamental risks it points out.
Tension is actually the report's greatest strength, but the way it's structured right now is, it's diluting its impact. The weakness is that the report creates a pretty jarring tonal shift. It segments the bull case, which is all hype, and the bear case, the reality check, so cleanly.
Right.
And that transition from talking about a lotto ticket price and squeeze metrics to the blunt reality of, hey, they need cash, it just creates a whiplash effect.
And that whiplash has a real consequence, doesn't it? It risks undermining the credibility of all the cautionary advice.
Totally.
Especially in the eyes of a highly speculative trader. If they just skim the report, they'll grab onto the hype.
And they'll dismiss the bear case section as just, boilerplate due diligence that they can ignore.
The goal is engagement, sure, but it's also education.
Exactly. So the suggestion for improvement is structural. We need to integrate those high-risk warnings much earlier, weave them directly into the bullish catalyst discussion. That ensures the risk is understood right alongside the opportunity, instead of being treated like some separate thing you can just skip over.
But if we do that, if we integrate the risks so early, does that, dilute the initial powder keg hook that draws people in?
Are we softening that viral angle too much by immediately pointing out the funding problem?
No, not if we frame the risk as the source of the urgency. We're talking to expert traders here. They get that risk is where volatility comes from. We elevate the analysis by connecting those dots right away.
Okay.
For instance, instead of waiting until Section 3, introduce the dilution risk, the number one danger, right there in the viral hook in Section 1.
Can you give me a concrete example of how that integrated framing would sound?
Certainly. You could phrase the lotto ticket price not just as attractive, but like this. At 96 cents, the price is psychologically attractive. But this proximity to the NASDAQ $1 delisting threshold simultaneously heightens the urgency for the company to raise cash, making unfavorable financing a near-term systemic risk.
I see. So that immediately ties the cheap price to the compliance clock and the dilution threat. It makes the risk feel immediate, quantifiable.
Yes.
And we could apply this to the positive catalyst too. Like when discussing the $10 million BSS deal, you could immediately contextualize it with the financial reality.
Yes, a strong example would be phrasing it like this. This $10 million deal is a significant win and provides operational credibility. But given the company's high cash burn, estimated at X million per quarter, the volume of future contracts required to truly secure financing independence needs to be explicitly quantified.
That gives it immediate balance. It avoids just being a cheerleader.
It shows the real scale of what's needed just to get rid of that dilution threat.
Right. Integrating the downside into the upside makes the whole report much more robust. It shows you respect the intelligence of the trader reading it.
Okay, let's move to that core risk itself. While the analysis is right to identify dilution as the #1 danger, the report could be way stronger by detailing the specific, actionable ways this risk might actually show up.
That's a key area for development. The weakness right now is that the current statement, which just says if they do an offering, the stock drops, is, well, it's true, but it's too generic for this audience.
It's obvious.
It is. And given the high insider ownership, 34 to 37%, and the pressure of being under $1, the specific triggers that would force management to dilute, those are the critical missing pieces.
And without spelling out those triggers, the advice to avoid becoming a bag holder just feels passive. It's not actionable.
Exactly.
So the suggestion is to provide specific, measurable signals or checkpoints that could indicate that financing is imminent. We need to move dilution from just a general threat to a measurable trading variable.
Absolutely. And this means connecting that fundamental weakness, the high cash burn, directly to technical timing and compliance rules. Let's focus on the compliance factor first. Since CS&YT is under $1, the report should really analyze the typical NASDAQ compliance timeline.
So basically, hypothesizing management's financial roadmap, not just stating the risk.
Precisely. The report could hypothesize that staying under $1 for a significant period, say 60 or 90 days, could pressure management to do a reverse split or an unfavorable financing deal before a formal delisting notice even comes.
That gives the trader a tangible deadline to watch.
It does. And we have to factor in what the insiders want. Detailing how that high insider ownership might influence the timing of any dilution is key.
Right, they have a vested interest in raising cash at the highest possible price.
Exactly. So a concrete example tied directly to the technical chart would be invaluable. Something like, insiders holding over a third of the float may strongly resist dilution until the 105 technical resistance is tested, hoping to capture a higher offering price. If 105 fails to hold, the immediate window for a raise may open up due to management's need for capital.
That's really specific. It turns a technical level into a fundamental trigger. But what about for the daily retail trader who isn't charting insider resistance? What's the absolute alarm bell?
That's where you introduce the regulatory filings. This report needs a critical daily check for the trader, the immediate filing of an S3 or 424B document.
Okay.
These are the filings that often come right before a registered offering. They provide a direct, non-technical warning signal that requires immediate action. It transforms the generic danger into a preemptive warning system.
So the argument is that by understanding the motivation, which is the insider timing, the regulatory pressure, the compliance clock, and then the final signal, which is the S3 filing, the trader has 3 layers of defense against becoming a bag holder, not just one general fear.
That's the kind of depth this type of analysis requires. It justifies the expert trader audience you're aiming for.
Okay, let's turn to the execution strategy then. The presentation of the key technical levels and the overall trading strategy, it should be more tightly integrated with the core meme volume trigger. It needs to create a cohesive, step-by-step roadmap for the trade.
The weakness here is that the report identifies the key technical levels, the 90-cent support, the 105 bounce point, the 88-cent stop loss, but it does it separately from the verdict section, which advises watching for volume spikes.
Right, the connection is sort of implied, but it's not explicitly defined as a conditional strategy.
And that ambiguity leaves the trader wondering, well, do I enter the trade before or after the volume comes in?
Or at what price relative to that 90-cent support?
Yeah, exactly. The suggestion is to create a defined conditional entry and exit matrix. It needs to clearly link the technical boundaries directly to the volume confirmation metrics. That would make the speculative buy rating unambiguously actionable.
So we need to define the meme trigger precisely.
We do. Let's integrate that volume threshold right into the technical roadmap. Reframe the bull scenario, the 90-cent hold and bounce to 105 by making the volume the actual qualifier.
How would we articulate that specific validation point?
We need to state it clearly. Something like, the technical signal for a confirmed double bottom occurs not just when 90 cents holds, but specifically when the bounce to 105 is driven by sustained buying volume exceeding 1 million shares in the first trading hour. You see? That is the clear signal that the meme crowd has arrived and validated the high-risk entry.
That sets a really clear, time-sensitive entry condition based on the report's own logic. And we can use those technical levels to quantify the risk-reward of the squeeze itself, which is the core thesis here.
Building on that, let's connect the short interest, the 40%, directly to the technical levels. The report should state explicitly that a sustained break above 105 is the specific price point needed to initiate the first critical stage of forced short covering. The shorts are anchored below $1. Forcing a break above 105 validates the move and shifts the entire market dynamic from accumulation to actual squeeze mechanics.
That gives a clear target and a rationale for why 105 matters fundamentally, not just on a chart. Okay, finally, let's make sure the stop loss is justified, not just stated.
Yes, let's strengthen that stop loss section. Instead of just recommending a hard stop below 88 cents, tie it to the complete failure of the technical structure. If that critical 52-week low at 90 cents breaks, the 88-cent stop loss isn't just a trading roll. It's confirmation that the entire technical structure has collapsed.
So it kicks off price discovery mode downwards.
Exactly. It initiates price discovery toward 80 cents or even lower. This framing validates the action. It confirms the entire speculative thesis is invalidated if that floor breaks. It tells the reader why they must get out, not just where.
It transforms the 88-cent stop from just a cautionary measure into the fundamental point of failure for the entire investment thesis.